As of the close of the most recent trading session on Friday, August 7, 2026, the stock market is currently closed, and NUBURU, Inc., trading under ticker symbol BURU, finished at 5 cents per share, showing a neutral session after experiencing volatile intraday swings between 4 cents and 6 cents on heavy trading volume exceeding 9 million shares. When a company trades at 5 cents per share, the consensus among retail traders browsing through a Robinhood app or checking stock updates on a Fidelity mobile app is usually straightforward. Most market participants write off a microcap stock sitting at this level as a spent shell, assuming it is merely riding out the final stages of capital exhaustion before fading into complete irrelevance. The expectation is that NUBURU is just another distressed penny stock trapped in an unavoidable downward spiral, but the reality sitting right beneath the surface tells a far more complicated story. While mainstream headline readers see a beaten-down penny stock struggling with exchange compliance and low valuation, institutional speculators and specialized tech investors are tracking a massive balance sheet restructuring. NUBURU recently completed a substantial $38 million public capital raise, cleared $16.75 million in outstanding debt, and secured approval from Italian regulators to acquire a 70% majority stake in Tekne SPA, an established defense and aerospace electronics manufacturer. That contrast between extreme market pessimism and aggressive operational pivoting creates one of the most polarizing setups on Wall Street today. To understand why this gap between market perception and corporate action exists, you have to look at how retail traders approach self-investing on platforms like SoFi Active Investing or an interactive broker's platform. When individual retail traders search for online investment opportunities or look for general investment help across popular investing sites, their focus naturally gravitates toward large-cap tech titans. People naturally follow headline megacaps like Tesla stock, Apple stock, or Nvidia stock, where liquidity is massive and corporate stability is taken for granted. When those same investors look at an individual brokerage account and see a penny stock trading under a dime, they assume the underlying business is completely stagnant. That expectation of total collapse, however, ignores the recent mechanics of NUBURU's trading behavior. Over the past few weeks, daily trading volumes on the Interactive Brokers stock trading system and other major venues have repeatedly surged past 20 million shares, far above the stock's historical baseline. When a microcap company undergoes this level of high-volume turnover, it signals that ownership is rapidly changing hands. Day traders utilizing Robinhood stock trading and long-term speculative buyers using a Fidelity brokerage account are battling over whether this restructuring will actually stabilize the business. The main driver behind the stock's recent daily price action stems from the sheer scale of its financial recapitalization. A few weeks ago, NUBURU priced a public offering at 15.5 cents per share, generating $38 million in gross proceeds. In the short term, issuing new shares creates significant dilution, which explains why the share price immediately dropped down toward 5 cents as existing holders adjusted to the expanded share count. However, the management team used those proceeds immediately to wipe out $16.75 million in outstanding debt, drastically reducing the interest burden that had been dragging down operating performance for quarters. When investors evaluate an investment through automated services like Schwab Intelligent Portfolios or a SoFi robo-advisor, tiny distressed equities are automatically filtered out due to volatility parameters and strict capital preservation algorithms. But for active traders managing their own portfolio through an interactive broker's account or using Fidelity Wealth Management for direct self-directed equity selection, microcap restructurings present a very different risk-reward dynamic. If a company clears its primary debt burdens, its enterprise value calculation changes overnight, even if the equity market cap takes time to adjust to the new reality. At this point, you might be asking yourself if this financial engineering translates into a real operational business. To answer that, we have to look closely at what NUBURU actually produces. Founded as an industrial laser specialist, NUBURU engineered high-power blue laser technology designed specifically for metal processing, welding, and additive manufacturing. Traditional infrared lasers struggle to weld reflective metals like copper and aluminum because those materials bounce away most of the infrared light energy. Blue laser light, by contrast, is absorbed up to 8 times more efficiently by copper, allowing manufacturers to create cleaner, faster welds with far less thermal distortion. This technological foundation initially targeted the electric vehicle battery market and consumer electronics assembly, where precision copper welding is critical. However, commercial adoption moved far slower than management anticipated, leading to heavy cash burn, quarterly net losses, and an escalating debt burden that ultimately forced the stock off the NYSE American exchange onto the OTC pink market. Recognizing that industrial welding alone could not sustain the enterprise, leadership shifted focus toward military, defense, and counter-drone applications. This operational shift brings us directly to their latest catalyst, the acquisition of Tekne S.p.A. Italy's government recently gave full regulatory clearance for NUBURU to acquire a controlling stake in Tekne, a firm that specializes in tactical military vehicles, electronic warfare systems, and specialized defense communications. Alongside this corporate move, NUBURU announced successful preliminary test results for its Laser Dazzler technology, which is designed to counter unmanned aerial vehicles by disrupting optical sensors on incoming drones. This is where expectation collides directly with reality once again. The market's current expectation, reflected in the 5-cent stock price, is that counter-drone testing and international acquisitions are speculative distractions designed to keep the ticker alive. The reality is that the global counter-UAS market is expanding at a rapid pace due to modern conflict trends, and prime defense contractors are actively searching for scalable optical-directed energy systems. If NUBURU successfully integrates Tekne's distribution channels and defense contracts, the combined company could convert its proprietary optical technology into recurring government hardware revenue. If you're following this analysis and evaluating your own portfolio strategy on the Robinhood app or through Fidelity Investments, take a quick second right now and drop a comment below. Comment below how many shares of NUBURU stock you currently hold in your account, or share your thoughts on whether micro-cap defense tech stocks are worth the risk. Seeing where the community stands on high-risk turnaround plays gives everyone a better pulse on retail market sentiment. When you look at online investing across popular platforms like SoFi Investing or Fidelity IRAs, it becomes clear that managing risk on microcaps requires a completely different mindset than holding large-cap mutual funds or Fidelity ETFs. In a standard intelligent portfolio, assets are spread across diversified indices to smooth out daily drawdowns. But in self-investing, taking a position in a company trading at 5 cents means accepting extreme volatility, dilution risk, and liquidity constraints. The broader macroeconomic environment adds another layer of tension to NUBURU's trajectory. High interest rates over the last 2 years made debt financing extremely expensive for unprofitable technology firms. Microcap companies that relied on convertible notes or high-interest debt instruments were crushed as interest expenses consumed their limited revenue. By utilizing its public offering to eliminate $16.75 million of outstanding debt, NUBURU essentially removed a financial timer that was ticking down toward restructuring. Now, the focus shifts entirely to execution. The primary risk facing shareholders today is whether the newly issued equity will result in ongoing dilution if operational revenue from Tekne and defense laser contracts fails to materialize fast enough. Investors who research stocks through interactive brokers' trading tools or review financial filings on investing sites know that balance sheet cleanups are only step 1. Step 2 requires generating positive gross margins and proving that customers will pay for blue laser solutions at scale. Looking ahead at potential future scenarios,
two distinct paths emerge for NUBURU stock. In the optimistic scenario, the integration of Tekne provides immediate top-line revenue, allowing the combined business to demonstrate growing sales in upcoming quarterly reports. If defense procurement officers begin placing purchase orders for optical counter-drone systems, the market could reevaluate NUBURU not as a failing industrial welder supplier, but as a specialized defense technology contractor. Under that scenario, short sellers and skeptics would be forced to cover, potentially triggering a sharp repricing from current penny levels. In the conservative or downside scenario, integrating an international acquisition creates operational friction, administrative costs escalate, and commercial adoption of its core blue laser systems remains sluggish. If cash burn resurfaces, management might be forced to return to the capital markets for additional equity offerings to retail investors who bought in through SoFi stocks or Robinhood fractional shares. To wrap up this analysis, the overarching lesson here comes back to the dynamic between expectation and reality. Market consensus sees a 5-cent stock trading on OTC Pink and assumes the business model